Have you ever questioned if you're performing better or worse than everyone else regarding finances? Perhaps you're awake at night contemplating your account balance, wondering if other individuals your age possess more saved than you do. Or maybe you're browsing through social media, observing individuals posting about their latest trip or brand new vehicle, and you can't help but question how they manage it all. Well, today I'm going to reveal the financial reality of the typical individual, and I guarantee some of these figures are going to astonish you. Some might make you feel better about your circumstance, while others might be a serious reality check. Either way, by the conclusion of this video, you'll possess a crystal clear perspective of where you stand financially compared to everyone else. My name is Peter, and I help individuals comprehend money, personal finance, and constructing wealth. If you're interested in organizing your finances and perhaps even advancing ahead of the pack, make sure to subscribe to the channel and hit the like button if this information helps you out. Before we explore these eye-opening statistics, let me pose something to you. When you contemplate the typical individual's financial circumstance, what enters your mind? Do you envision someone who possesses their situation organized, steadily constructing wealth and preparing for retirement? Or do you imagine someone who's fundamentally existing paycheck to paycheck, hoping everything functions out in the conclusion? The reality is, most of us possess no concept what normal genuinely resembles regarding finances. We might possess assumptions based on what we observe around us, but the reality is often very distinct from what we imagine. And here's the thing that makes this complete topic so fascinating. Comprehending these figures isn't merely about satisfying your curiosity. It's about providing you the information you require to execute better choices with your own capital. Contemplate it this way. If you're attempting to achieve fitness, wouldn't you want to recognize what the typical individual weighs or how much they exercise? If you're attempting to improve your grades, wouldn't you want to recognize how you compare to other students? Capital functions the identical way. When you comprehend where you stand compared to everyone else, you can execute more informed selections about your spending, saving, and investing. So let's begin with something that influences every single working individual in this country. Income. When you receive your payment every 2 weeks, are you earning more or less than the typical worker? According to the most recent data from the Bureau of Labor Statistics, the median weekly earnings for a full-time worker arrived at just above $1,000. Now that functions out to roughly $52,000 yearly before taxes. Now let me break that down somewhat more. We're discussing individual income here, not household income, which would include a spouse or other family members who might be working. And when we state median, that means half of all workers earn more than this amount and half earn less. It's the middle of the pack. If you're generating around 26 hourly, you're right there with the typical full-time worker. But here's where it becomes fascinating. That $52,000 figure is before taxes are removed. After federal taxes, state taxes, Social Security, and Medicare, that number diminishes pretty rapidly. Depending on where you reside, you might be taking home somewhere between $35,000 to $40,000. Suddenly, that doesn't seem like quite as much capital, does it? But income is merely one component of the puzzle. What genuinely matters is what individuals are executing with that capital once they earn it. And this is where things become genuinely fascinating and honestly somewhat concerning. Let's discuss retirement savings because this is where numerous individuals are in for a rude awakening. According to the Federal Reserve's most recent survey, the median amount that Americans possess saved for retirement is $65,000. Now, before you begin feeling excessively positive or negative about that figure, remember that this includes individuals of all ages who genuinely possess retirement accounts at all. Here's the significant part. Approximately 25% of Americans don't even possess a retirement account. They possess $0 saved for when they stop working. Zero. That means 1 out of every 4 individuals you encounter is planning to rely entirely on Social Security when they retire, assuming it's even still functioning by then. For those who do possess retirement savings, the figures vary dramatically by age, and some of them are pretty alarming. Individuals under 25 possess a median balance of below $2,000. Now, to be equitable, if you're 23 years old and merely beginning your career, possessing $2,000 saved is genuinely not terrible. But it does highlight how significant it is to begin early. The 25 to 34 age group performs somewhat better with a median balance of around $14,000, But even that amount seems pretty modest when you consider that these are individuals who have been working for several years and should be reaching their stride financially. By the time we reach the 65 and older group, the median balance climbs to around $88,000. And while that might sound like a decent amount of capital, let's position it in perspective. If you retire with $88,000 and follow the traditional 4% withdrawal rule, you'd be able to extract approximately $3,500 yearly from your retirement accounts. That's below $300 monthly, $300 monthly. Contemplate that for a moment. Could you exist on $300 monthly in retirement? Even if you possess your residence outright and possess no mortgage payment, $300 wouldn't manage your groceries, utilities, healthcare, and everything else you require to survive. This is why comprehending these statistics is so significant. If you're in your 20s, 30s, or 40s and you're examining these retirement figures, you should be having a serious conversation with yourself about whether you're saving enough, because the typical individual clearly isn't. Regarding Social Security, since so many individuals are planning to rely on it heavily, let's examine what the typical benefit genuinely provides. The Social Security Administration reports that the typical monthly benefit is around $550. That's approximately $18,600 yearly. Now, $18,000 might sound like it could be manageable, particularly if you don't possess a mortgage payment. But remember, this is the typical payment. If you possessed years where you didn't work or earned very minimal capital, your benefit could be significantly lower than this. And if you're someone who never earned much during your working years, you might be examining a Social Security check that's barely sufficient to maintain the lights functioning. On the opposite side, some individuals accept a completely distinct approach to Social Security. They organize their retirement assuming they won't receive anything from Social Security, treating any benefit they do receive as a bonus. This might seem excessively cautious, but given the long-term funding challenges facing the program, it's probably not a poor way to contemplate it. But let's shift focus and discuss something that influences your day-to-day existence right now: spending. How much does the typical household genuinely allocate each month? According to the Bureau of Labor Statistics, American households allocate an average of approximately $5,577 monthly. Throughout the course of a year, that accumulates to roughly $67,000 in total spending. Now contemplate what this means. If the typical household is allocating $67,000 yearly, they're required to bring home at minimum that much merely to break even. And remember, we're discussing take-home payment here, not gross income. So if you want to possess any capital remaining for savings, investments, or constructing wealth, you require to be earning significantly more than $67,000 yearly as a household. This spending breaks down into some pretty predictable categories, but the amount might surprise you. The largest portion travels to housing, which shouldn't surprise anyone who's ever allocated rent or mortgage. The typical household allocates approximately $1,885 monthly on housing expenses. That includes rent or mortgage payments, property taxes, insurance, utilities, and maintenance. $1,985 monthly on housing. That's above $22,000 yearly merely to maintain a roof above your head. And if you're residing in a major city, you're probably finding that figure surprisingly low. In locations like San Francisco or New York, $1,800 might obtain you a closet with a window if you're fortunate. Food arrives as the second largest expense, with the typical household allocating approximately $691 monthly on groceries and dining out. That's above $8,000 yearly merely to maintain everyone fed. And honestly, if you're allocating below $700 monthly, feeding your family, you're probably executing something correct. Either that or you've mastered the art of existing on budget meals and basic sandwiches. Transportation consumes another $939 monthly, which manages vehicle payments, insurance, fuel, maintenance, and public transportation. Nearly $11,000 yearly, merely to travel from location A to location B. And this is why some financial specialists suggest that your housing and transportation expenses combined shouldn't exceed 50% of your income. When you accumulate that $1,800 for housing and $900 for transportation, you're already at $2,700 monthly. And we haven't even discussed anything else yet. Now, let's explore something that can create or break your financial future: credit scores. Most individuals recognize they should care about their credit score, but they might not recognize where they genuinely stand compared to everyone else. According to Experian, the typical FICO score in America is 715, which is genuinely pretty solid. Credit scores range from 300 to 850, so 715 positions the typical individual in what's considered favorable credit territory. But here's what's fascinating about this figure. It means that numerous individuals are executing at minimum some things correct regarding managing their credit. They're generally allocating their bills on time and maintaining their debt levels reasonable. But don't permit that 715 average deceive you into assuming everyone possesses their credit circumstance figured out. There are still plenty of individuals existing with scores in the 500s and 600s, questioning why they can't receive approved for decent interest rates on anything. Your credit score influences everything from your mortgage rate to your vehicle loan terms. And even some employers verify credit scores before hiring. The positive news is that maintaining a decent credit score isn't complicated science. Allocate your bills on time, don't maximize your credit cards, and avoid establishing new credit accounts every time you want to preserve 10% at the checkout counter. It's genuinely that simple, but somehow a significant portion of the population still manages to complicate it. Regarding credit, let's discuss the challenging topic, credit card debt. This is where things become unpleasant rapidly. The typical household is carrying above $9,000 in credit card debt, $9,000. That's not a vehicle loan or a mortgage where you're purchasing something that maintains value. That's $9,000 allocated on items that's probably positioned in closets gathering dust or already discarded. What makes this even more painful is the interest rates on credit cards. We're discussing 15, 20, sometimes 25% or higher. If you're allocating 20% interest on $9,000 in credit card debt, you're discarding $1,800 yearly merely in interest payments. That's capital that could be traveling toward constructing wealth. But instead it's making credit card organizations wealthy. Here's the thing that genuinely concerns me about credit card debt. Most of it originates from purchasing things individuals don't genuinely require. Certainly, sometimes individuals use credit cards for emergencies or unexpected expenses, but let's be honest, numerous of that $9,000 traveled toward clothing, electronics, dinners out, online purchasing sessions, and impulse purchases that seemed like a favorable concept at the time. The solution is pretty straightforward, even if it's not constantly simple to implement. Allocate your credit card balances in complete every single month. If you can't manage to allocate cash for something, don't position it on a credit card unless it's a genuine emergency. And if you're already carrying a balance, execute allocating it your top financial priority even before you begin investing for retirement. There's no purpose in earning 7% in the market if you're allocating 20% on credit card debt. Now let's discuss net worth, which is probably the optimal single figure for measuring your overall financial wellness. Net worth is simply what you possess minus what you owe. Accumulate the value of your residence, your vehicles, your bank accounts, your retirement accounts, and everything else you possess. Then subtract your mortgage, credit card debt, student loans, and any other capital you owe. Whatever remains is your net worth. According to the Federal Reserve, the median net worth for American households is approximately $122,000. But merely like with retirement savings, this figure varies dramatically by age, and some of the breakdowns are pretty eye-opening. If you're under 35, the median net worth is below $14,000. Now, if you're 25 years old and merely beginning your career, possessing $14,000 in net worth isn't terrible. But if you're 34 and still positioned at $14,000, you might want to possess a serious conversation with yourself about your financial trajectory. The 35 to 44 age group performs better with a median net worth of $91,000. The 45 to 54 group reaches $168,000. Individuals between 55 and 64 possess a median net worth of $212,000, and those 65 to 74 years old reach $296,000. Here's what I locate fascinating about these figures. They're genuinely pretty achievable for most individuals with decent incomes and some fundamental financial discipline. You don't require to be a market expert or launch the next significant tech organization to reach these milestones. You merely require to consistently allocate less than you earn and invest the difference. But there's another aspect to this situation that we require to address: savings rates. How much of their income is the typical individual genuinely allocating aside? The Bureau of Economic Analysis demonstrates that Americans save approximately 6% of their income after taxes. 6%, that's it. Now 6% might not sound terrible, but let's contemplate what this genuinely means. If you're saving 6% of your income, and some of that requires to travel towards short-term objectives, like purchasing a vehicle or executing a down payment on a residence, there's not much remaining for long-term wealth construction. Consider this: the typical down payment on a residence is $62,000. The typical kitchen renovation costs $26,000. A new vehicle averages above $47,000. If you're only saving 6% of your income, and you require to finance all these shorter-term objectives, how much is genuinely making it into your retirement accounts? Most financial specialists suggest saving at minimum 10 to 15% of your income specifically for retirement. And that's on top of whatever you're allocating aside for other objectives. If you want to retire early and not possess to work until you're 70, you probably require to be saving even more than that. This introduces us to something that might surprise you: retirement age. When do you assume most individuals genuinely stop working? If you guess 65, you'd be close, but not quite correct. According to recent data, the typical retirement age in America is 61. Now that might sound pretty favorable initially. Who wouldn't want to retire at 61 and allocate their golden years executing whatever they want? But here's the situation. Most individuals can't collect their complete Social Security benefits until age 67. So if you're retiring at 61, you possess 6 years to bridge that gap somehow. And if your retirement savings resemble anything like those median figures we discussed earlier, those 6 years might be pretty lean. Here's another way to contemplate it. If you begin working at 22 and retire at 61, you've been in the workforce for 39 years. That's nearly 4 decades of getting up early, commuting to work, dealing with supervisors, positioned in meetings, and executing whatever it is you execute to earn a payment. After all that time, you finally obtain to retire with perhaps $88,000 in your retirement account, which we already established provides you approximately $300 monthly to exist on. Does that sound like a favorable arrangement to you? Because honestly, it sounds like a pretty poor arrangement to me. But here's where it becomes even more fascinating. The Social Security Administration states that someone who reaches age 65 can expect to exist another 19 to 21 years. So if you retire at 61, you might possess 25 years or more of retirement to finance. 25 years is a long time. That's longer than most individuals' complete career up to that point. And here's the question that should maintain you awake at night. How many of those 25 retirement years are you going to be healthy enough to genuinely enjoy? At 61, there's a decent chance you're still in favorable shape, but what about at 71 or 81? Time possesses a peculiar way of catching up with all of us. And the activities you can execute at 65 might not be the identical ones you can manage at 75. This is why comprehending these financial statistics isn't merely about satisfying curiosity. It's about recognizing that the typical individual's approach to capital isn't functioning very well. When the typical American possesses below $90,000 saved for retirement and is carrying $9,000 in credit card debt, something is seriously incorrect with the perspective. But here's the positive news, and this is why I wanted to share all these figures with you. Once you recognize what typical resembles, it becomes pretty clear how to execute better than typical. And executing better than typical doesn't demand some magical formula or secret knowledge that only wealthy individuals possess. If you're consistently saving more than 6% of your income, you're already ahead of most individuals. If you're avoiding credit card debt, you're way ahead of the competition. If you comprehend what you're investing in, and you're genuinely positioning capital into retirement accounts on a regular basis, you're surpassing the competition. The reality is that most of these statistics are pretty achievable to surpass with some fundamental financial discipline. You don't require to earn a 6-figure salary or inherit capital from a wealthy relative. You merely require to be more intentional about your capital than the typical individual. And honestly, that standard is positioned pretty low. Contemplate it this way. If the typical household is allocating $5,500 monthly, and you can figure out how to exist comfortably on $4,500 monthly, you've merely released $12,000 yearly for savings and investments. Execute that consistently for several decades, and you'll be in a completely distinct financial league than most of your peers. The identical principle applies to all of these statistics. Surpass the typical by somewhat in multiple areas, and the compound effect across time becomes massive. Earn somewhat more than $52,000 yearly, save more than 6%, avoid credit card debt, and invest consistently in low-cost index vehicles, and you'll retire with significantly more than $88,000. What I locate most fascinating about all of this is how these figures reveal the gap between what individuals state they want and what they genuinely execute. Everyone states they want financial stability. Everyone states they want to retire comfortably. Everyone states they want to stop concerning about capital. But the typical individual's behavior doesn't match up with these objectives. Perhaps that's because most individuals don't genuinely recognize what typical resembles. Perhaps they assume everyone else possesses their financial situation organized, so they don't feel any urgency to alter their own patterns. Or perhaps they recognize they should be executing better, but they don't recognize where to begin, or they assume it's too late to execute a difference. If you're observing this video and some of these statistics resonate somewhat too close to home, don't panic. The fact that you're here learning about capital and attempting to comprehend your financial circumstance already positions you ahead of numerous individuals. Most people never even accept the time to figure out where they stand or what they require to execute distinctly. The essential element is to utilize these figures as motivation, not as an excuse to abandon. If you're 35 with below $14,000 in net worth, that doesn't mean you're destined to financial mediocrity. It means you possess some work to execute, but you also possess 30 years or more to obtain it correct. And if you're already executing better than these averages in some areas, don't permit that success make you satisfied. Perhaps you possess a solid credit score and no credit card debt, but your retirement savings are behind. Or perhaps you're excellent at saving capital, but you're maintaining it all in a savings account, earning practically nothing instead of investing it for expansion. The fundamental point is this: these financial statistics of the typical individual should be eye-opening, but they should also be empowering. When you recognize what normal resembles, you can execute informed choices about whether you want to be normal or whether you want to be better than that. Personally, I assume you deserve better than retiring at 61 with $88,000 and hoping Social Security doesn't exhaust capital. You deserve better than carrying credit card debt and allocating every dollar you earn. You deserve the tranquility that originates with possessing your financial situation organized. These statistics demonstrate us where the typical individual finishes up, but they don't possess to define where you finish up. Utilize them as a beginning point, not a finish line. Because once you comprehend what most individuals are executing with their capital, it becomes pretty clear how to execute something distinct and obtain considerably better results. The selection is yours.